The Reserve Bank convenes and outlines goals and policy directives moving forward with the economic recovery from the coronavirus pandemic. On Tuesday, the RBA board met to discuss forthcoming monetary policy decisions ascertaining to the Australian economic recovery from the pandemic. Governor of the RBA, Philip Lowe, then issued a statement before hosting a press conference. He cited 3 specific policy objectives set by the RBA board in the meeting. Before we get into those, the Governor touted some economic achievements during the recovery thus far. He said that the Australian economy is on a positive path. Output is now above pre-pandemic level, and more Australians have a job than they did before the pandemic. The unemployment rate has returned to its pre-pandemic level, underemployment has declined, and job vacancies are at a high level. So, we are in a much better position than we thought we would be in. This is a testament to the expansionary fiscal and monetary policies which have been employed in reaction to the associated downturn from the pandemic. Some data from the ABS report from December 2020 to the March 2021 quarter, which was released last month, highlight these improvements. It found that GDP rose 1.8% in the quarter, reflecting the continued easing of COVID restrictions and the recovery of the labour market. The economic activity was now 0.8% above pre-pandemic levels and has grown 1.1% in the last year. The terms of trade, that is, the ratio of the price of exports to the price of imports, rose by 7.4% in the quarter, and is at its highest level since December 2011. Stronger export prices, particularly for iron ore and LNG, drove the quarterly rise, and the strength of the terms of trade contributed to a 3.5% increase in nominal GDP. This means that the increase in the price of exports outstrips the loss of demand due to the law of demand, and hence aggregate demand and GDP have risen. The great forward-looking indicator for the Australian economy, which was found, is that in that quarter, private demand drove growth, to quote the ABS. Philip Lowe did note that the labour market has become distorted due to the stoppage of our international borders. He said that one issue we are watching carefully is how the balance of supply and demand in the labour market is being affected by the closure of our international borders. There have been increased reports of labour shortages in parts of the country, and a step up in wage increases for some occupations. He then went on to list 3 policy objectives, which the board of the RBA outlined during their meeting. The first goal was the yield target. They have looked to retain the April 2024 bond as the bond for the yield target, and retain the target of 10 basis points. That is, the bonds will mature in April 2024. In other words, this is the time when the government will buy back bonds. In case you don't know what government bonds are, issuing government bonds is a part of debt financing, whereby the government borrows money from the public in order to afford their fiscal stimulus. In return for borrowing the money, the government issues bonds, which are essentially a type of loan which has to be paid back at a certain time with a certain rate of interest. This interest is paid at regular intervals. In this case, the bonds must be paid back by April 2024, with an interest rate of 10 basis points or 0.1%. The governor said, "The situation today is quite different from that in March last year. We are no longer looking over a cliff, but instead transitioning from recovery to expansion. This is a key point which was also echoed in the Prime Minister's address last week. This improvement has widened the range of plausible scenarios for the cash rate. Our central scenario continues to be that the condition for an increase in the cash rate will not be met until 2024. But there are alternative plausible scenarios as well. This means that probabilities have shifted, and the decision to adjust the approach to the yield target reflects this shift in probabilities. The board remains committed to the target of 10 basis points, which is the same rate as the target for the cash rate. The cash rate is something we'll get into in a moment. But the second policy directive was the bond purchase program. The only difference between a bond and any other loan is that bonds can be traded in the market, and hence they have a market price. That is where supply meets demand. This is where the bond purchase program comes into play. This is where the RBA is buying bonds in the secondary market from individuals and businesses rather than from the government itself. In order to buy these bonds, the RBA is electronically printing money in a process which is known as quantitative easing, or monetary financing. This is an extremely inflationary policy which has not been used much in Australia recently. It was most notably used during the Whitlam government, which was characterised by high spending and inflation levels. The governor said the second $100 billion tranche of purchases will be completed in early September. We will continue to purchase bonds after this date, providing ongoing support to the Australian economy. These purchases will be at a rate of $4 billion a week, rather than the $5 billion a week under the current program. This adjustment in weekly purchases is a reaction to the improved situation, while acknowledging that, as the governor said, we are still well short of our goals for full employment and inflation, and this means that a continuation of monetary support through bond purchases is appropriate. He noted that the board will next review its rate of purchases at the November meeting, and its decision will reflect the balance of two factors. First, they want to be able to react to economic uncertainty more readily. Hence, re-evaluating their policies at more frequent intervals allows them to do so. The second is that their guidance about future bond purchases helps with market pricing. And the more information the market has about these purchases, the more efficiently they can be reflected in market prices. The third policy directive was to maintain the cash rate target at 10 basis points. The cash rate reflects the price of money, as it is the return on savings, or in this case, the cost of borrowing, when banks borrow money from the Reserve Bank. The cash rate is used as a basis for the interest rates, which are set by the banks when individuals look to save or borrow money. Maintaining the cash rate means that the banks will be able to borrow from the RBA at the same rate of repayment as before. Hence, the interest rates are likely to stay around the same point. A cash rate target of 10 basis points, or 0.1%, means that for every $1 borrowed, 0.1% of that, or 1/10 of a cent, has to be repaid in interest. Such a low rate of repayment means that there is a low return on savings, but also a low cost of borrowing. Hence, the Reserve Bank is attempting to encourage consumers and businesses to spend and not save. This indicates the expansionary monetary stance employed by the Reserve Bank, as they are attempting to boost the economy as we look to increase inflation and decrease unemployment. However, with such a low cash rate target, it means that the Reserve Bank no longer has much room to decrease interest rates. They most likely do not want to go into negative interest rates, whether banks actually pay people to borrow money, as has been used in Japan and some European nations in the past. This is the reason why they have looked to other, more unconventional methods, such as the quantitative easing, which we mentioned before. The governor said that the board does not intend to increase the cash rate until inflation is sustainably within the 2 to 3% range. It is not enough for inflation to be forecast in this range. We want to see results before we change interest rates. For reference, inflation has most recently been measured to be 1.1%. The governor continued, "For inflation, the central forecast was for it to just reach 2% by mid-2023. This is the basis for our guidance that we do not expect the cash rate to be increased until 2024 at the earliest." Well, now that we've gone through the Governor of the RBA's announcement, let's have a look at some of the reaction to this announcement from other sources. An article by Brianna McKee at Sky News said that the Reserve Bank has announced a more adaptive monetary policy which will taper quantitative easing measures in response to Australia's skyrocketing property market. This is because monetary policy has a particular effect on the housing market, due to how closely it is tied with the cost of borrowing. And this is the reason why some people blame the US Federal Reserve's low interest rate policy for creating a bubble in the US housing market, which led to the GFC. The article went on to say that the bond buying changes points to a change in tune from the RBA and the decision to embark on a more flexible quantitative easing policy. It said that the need for stimulus has eased as the housing market goes up in value and the economic recovery continues. Hence why they have not looked to lower interest rates, and they are decreasing the amount of bonds they are buying each week. Mr. Lowe said the decisions made today by the central bank were taken against the backdrop of an economy which has bounced back earlier and stronger than expected. McKee noted that every week of lockdown is devastating for New South Wales businesses. But the RBA governor noted that while recent outbreaks of the virus would impact the economy in the short term, it would be sure to bounce back once they are lifted. Another article from Sky News said that the RBA has repeatedly said the cash rate will be kept on hold until 2024 at the earliest. But over the last couple of weeks, there has been speculation from some overseas central banks about raising interest rates earlier than expected. It has been suggested that the US Federal Reserve could be raising rates within the next 2 years. Also note that the Bank of New Zealand and Canada's Reserve Bank have also hinted at raising their cash rates. Sky News business reporter Ed Boyd said Westpac's chief economist Bill Evans believes the RBA will lift the cash rate in 2023, while the Commonwealth Bank's Gareth Aird believes it will be raised in November 2022. Another article from Ronald Meason, the economics correspondent at AFR, said that the market expectation was for a shift to flexible bond purchases, which the bank had previously flagged, but the smaller size, a decrease from 5 billion to 4 billion, came as a surprise. The ANZ head of Australian economics, David Plank, said that the first review is somewhat earlier than we expected. If the data remain robust, as we expect, then the market will factor in another tapering at that point. All up, a little more hawkish than we expected, but there is still a lot of bond purchases to come, and a rate hike is still a long way off. Well, looking forward, we will have to see how this monetary action taken by the Reserve Bank affects the Australian economy. But the strong and quick recovery provides a positive prospect looking forward. The most concerning issue, however, is the housing market, which once again has seen prices pick up, just like before the pandemic. Since monetary policy has an especially profound impact on the real estate market, this will be a point warranting great attention in the future.